What's up, everyone? Welcome to the Private BNB Formula podcast. My name is Alex Jarbo. I'm the host of the podcast, and today we have two really awesome people on. We have Kevin Hill, who is the CEO and one of the partners at Aloha Capital, and then we also have Caitlin, who is their queen of business development at Aloha Capital. What's going on, everyone?
Hey Alex, how are you?
What's up? What's up? So usually I leave it to the guests to sort of just talk about their companies and whatnot. So let's just start off with how Aloha Capital started and what Aloha Capital currently is today.
Sure. Yeah, Aloha's been around since, early 2015, I think it was. Kevin, maybe sooner than that or earlier than that. We are a private lender and we only lend on investment properties. So we don't do anything owner occupied, nothing in the conventional space. Our world is investment deals. So we started out doing your standard fix and flip, a lot of stuff in the Midwest, a lot of turnkey properties. And our business has morphed into kind of catering to the whole suite of residential investment space now. So everything from flips to 30-year loans for rental properties, short-term rental properties. We do ground up development. We do some small to medium-sized multifamily. So our company's really grown as we've expanded into, all sorts of niches of residential.
Yeah, and for everyone who's listening, would you mind explaining the difference between, say, like private capital and just like a normal bank? Like if you were to go to like a Bank of America or like a credit union, like what's the difference between private capital and just like a normal conventional bank and conventional financing?
Yeah, I'll touch on that, but Kevin's probably got more in depth. So we differ from a bank in that we are underwriting assets primarily based on their financial performance. So we're looking at each deal based on profitability, cash flow, risk exposure. Also, the underwriting of the borrower is important as well because we want to have great partnerships with our clients and have,
Right.
repeat deals with them, ongoing relationships. So we do look at their financials, their credit history, their experience in real estate, but the basis of what we do is going to be based on the project itself. Whereas a bank traditionally is looking more into the borrower and their financial capabilities. What would you add to that, Kevin, or change?
Yeah, I'd say you hit it pretty good. I would say the main difference is we do not pay attention to personal income. We look at the cash flow of the property once it's been renovated, or if we're providing a permanent financing loan, as is or estimated income, or the profitability if you're buying a property to rehab and flip it. So ignoring personal income and looking at the project specific income as a sale or as a rental. The main thing, as Caitlin touched on, is we do want people to be, financially fit to do that deal size. So we're looking at liquidity of the borrower group. We don't do loans just to individuals. We do loans to LLCs or entities. So a lot of our loans are to a group of investors. So we're looking at their liquidity, their relevant experience to the deal that we're going to finance, just to make sure that they're set up for success.
And based off because there's been just so much that's happened, say, in the last 6 months alone, based off the deals that you guys are currently seeing, what do you guys see like in the future of for the audience that's listening right now, say like just the short-term rental market, the vacation rental market, because you guys that's how we got connected originally was I was looking to do a loan with you guys. And what do you guys see on the types of deals that you guys are seeing now? I would even say we talked about it yesterday, just in the last couple months, that you guys have seen even a shift just in the last couple months of the types of deals that you guys are seeing on the VR side.
Sure. I'll try to tackle that question. So I would say there's generally been a reduction of transaction volume going back to the middle of last year on fix and flip investors. I think just nervousness of,
Right.
Is the value going to be there? Are we at the end of value appreciation? So there's been a little bit of slowdown of that until recently. We're actually seeing a spike in the last few weeks of investors coming to us for financing on.
What do you think attributed to that spike?
I would say my best educated guess would be that, you know, values have stabilized. So we're not in a market anymore in most markets where there's bidding wars on a property
Right.
for a property that's nice looking as is. And so since there's not bidding war on the nice looking properties that you're, as an investor, you're competing with primary residents, their starter. Since there's not bid war there, now those primary buyers aren't going to the ugly house on the block and trying to buy that thing. And so I think that's opened up, you know, the value of those have stabilized, come down. Those people that own those ugly houses, for lack of better words, aren't getting multiple bids. So they're selling at what they can sell at now, which creates enough meat on the bone for a flipper to buy it at a good price, renovate it, and sell it to that, you know, end buyer that's buying their first home or their primary residence. So I think that's what's driving a bit of the increase in fix and flip. It definitely has not, you know, we're not seeing the volumes of, you know, pre-2021 yet. And then our cash flow investors, so investors that are going out and buying properties to own them as rentals, you know, the hard thing there is you're fighting against increased interest rates. So where our 30-year loan back in, you know, early 2022, our lowest rate we could offer was 3.75. That lowest rate now is 6.757 for like a sweet deal,
Right.
or like, you know, high sevens or low eights. So it gets harder to hit that cash flow, to have a property cash flow on a long-term basis. So we are still finding people that are doing that, and it's very market specific. So I think, you know, just a little nuance there, you know, where real estate investing was kind of easy for the last 10 years because you're just buying, and by the time you finish your flip or your renovation, your property's gone up in value by
Like by
20%.
20% sometimes, yeah.
So that's not really there anymore. But there are still markets where the value to rent ratio is unique, and it's a lot of, you know, the Southwest and Midwest
Right.
states where you can still buy a property for a reasonable price, you know, $60,000 to $120,000. It might need some renovations, and the rent on that is significant compared to its value versus in our backyard in Denver, where that same square footage house costs $500,000. You're not gonna.
Yeah. Well, I grew up in the Detroit metro area in Detroit, Michigan, and that when you say like affordable houses, that's what I don't think about Detroit, but I think about like the suburbs of Detroit and stuff like that.
And so to finish kind of where we're at right now, what we're seeing is we are still seeing some people find opportunities where they can get financing in the higher rate range and get them to cash flow or break even. But where people are actually making money in cash flow is buying that property. It's in a submarket that supports either a medium-term rental or a short-term rental. And then, you know, depending on the market, that rent compared to the same rent on a long-term basis on that property might be 1.5 to 3x. So that's where we're seeing a lot of activity right now.
So you just touched on the next thing I want to talk about, which is midterm rentals. I mean, I didn't hear this topic until I would say 12 months ago, and then I feel like it's on every podcast. Books have been written on it and pushed out on it. Do you guys finance you just touched on it, financing the midterm rentals? And if you guys do, how are those midterm rentals underwritten compared to like a long-term rental or a short-term rental? And then if you wouldn't mind explaining to the people who are listening what a midterm rental exactly is in your guys' book, yeah.
Yeah, so we consider a long-term rental a 12-month lease. So any property that has a 12-month lease, we finance those. It's what most of our business has been going back, you know, 5 to 7 years. We provide 30-year loans on those based on the debt service coverage ratio, which I can jump into later. So it's not conventional loan. These are alternative finance loans. They don't look at your personal income. And so long-term lease is a year or longer lease. Everyone kind of knows what a short-term rental is. That's your classic vacation rental property, usually rented by the day or week. And then medium-term rental is something, you know, it's been happening for a while, but it's getting a lot of buzz because long-term rentals are not working so great right at the
Right,
moment.
in some areas, yeah.
Yeah. And so that's really going to be a 30 to 90 day typical rent. It's usually, it's probably a different podcast episode, but it's usually still has a lease in place to protect you as the landlord. But the tenant is, you know, the classic situation is a traveling nurse. You know, if you're buying a house near a big medical center, a big tech center might also work, where people are coming in for training, etc. And also universities, they tend to work as well. So someone's coming and renting it for a month or 2 months while they're in town. And so what we see is, you know, short-term rents can be 1.5 to 3x typically of long-term rent. And the medium-term rent can be, you know, I would say 1.5 to 2 times the long-term rent is what we typically see in reality. And so you're not quite getting as much juice as short-term renting it, but you are not having to have people in and out on a 3-day basis, dealing with cleaners, dealing with stains on your couch every 3 days. So it's a different model.
And if you want to touch on the debt service cover, the DSCR loans, and exactly how those are underwritten, say like compared to if I was just purchasing a primary residence, because I think that's the biggest thing that our students get hung up on is that they think the only way to get a loan is through just all their personal finances and just going through the debt to income ratio and all that fun stuff.
Sure. Yeah, I'll tackle that. So DSCR, debt service coverage ratio, is the rental income on a property divided by your gross expenses. So principal of the loan, interest on the loan, taxes and insurance. So it's a pretty simple formula. You know, a 1.0 means you're breaking even. 1.15, which is kind of our goal typically for people to have cash flow for the loan to qualify, means you're making, you know, that money beyond your expenses. And so what's unique about our lending, our loan program around these 30-year loans is we look at DSCR, we don't look at your debt to income ratio. That works really well for full-time real estate investors that gave up their W-2 job. That now you're you know, hard to deal with conventional lenders. And so we just look at the cash flow of the property. And so cash flow on long-term rent would be either your lease you have in place, and that's the number, or if you just renovated the house and it's not leased yet, we can still close that 30-year loan with a long-term rent estimate. If you're going to use that property as a medium or short-term rental property, we actually pull data from 1 of 2 sources, Revity or AirDNA. If you're investing in the space, I would suggest to go get an account with one of those companies. They have data that we can utilize. So we'll do 90% of the AirDNA estimate of your property for the top line of that formula for short-term rental. And we typically do 80% of it for a medium-term rental, just because you're probably not going to get as much income. So we're trying to set you up for success, right? We're doing this loan based on estimates. You know, if that estimate doesn't work out, you're not going to be cash flowing. You're going to be paying money every month into that investment. So we're trying to come up with an estimate that's accurate, that gives the investor the loan they want.
So if a student is say someone's coming to you guys with a deal, what work do you guys require, but I would say like to see on the front end of, like, do you guys are you guys looking for pro formas? Are you guys looking for projections prior to them even bringing you guys the deal? Obviously, I would say it needs to be under contract before they just start. I'm sure people have just sent you stuff off the MLS and stuff and be like, would you guys lend on this and whatnot? But what do you guys, if someone's coming to you, what do you guys like to see in terms of either due diligence on the person's end, or what exactly do you guys like? What in a perfect world, compared to just in a perfect world, what do you guys like to see in the work that's been done on the front end before I even come to you guys with a loan?
Sure. It differs depending on loan, so it's a different look for a bridge loan with rehab versus I'm going to buy a property, I'm going to operate as a short-term rental. So I guess if you're coming to us and looking for long-term financing on your rental property, you know, I would say have run some type of market report, property-specific report that shows what, you know, rental income you're going to get, and then, I mean, you look very smart to a lender if you know their kind of ballpark range of rates and you've calculated DSCR already. So,
Right.
you know, it's pretty simple. You can go online and throw interest rate in and loan amount in and get, you know, an amortizing monthly payment amount. You can do it in Excel. It's a simple formula. But going to a lender and saying, hey, I've already double checked DSCR at 80% of purchase price. It looks like this thing's golden. I want to put on our contract. Can you just double check me? So we definitely do see people.
Oh,
you
will work with them prior to even getting it under contract. I guess the reason I'm asking that question is, I mean, 8 months ago, it was even impossible to get that email out before it went under contract, but I guess now it's a little bit slower. Yeah.
I
Yeah,
was just gonna say,
go
ahead. I was just gonna say that that's part of my job, is to help people understand our programs and the basis of what numbers I am going to look at when you come to me with a property. And so, you know, I would say it's half and half. Maybe some more experienced borrowers already have a, you know, comfortable basis of what they're doing, what exactly they're looking for, and they are coming to us to verify, hey, these are the numbers I pulled. You know, how does this fit in with your program versus newer investors? It's my job to help them understand this is what we're looking at. Let's get you a good idea. And sometimes I'll even say, send me an example of a property that you like, and let's work off of an example term sheet so that moving forward, you kind of have a foundation, a basis of, this is the anticipated rate I'm working with. I can take this rate and this leverage and plug it into my spreadsheet over here, knowing that very likely it's going to fit. You know, if I do choose to go under contract before or after I speak with Aloha, it's going to work. So it's all over the map. But that's really our job, and my job is to, you know, help our clients get comfortable with that so they can go make offers and get out in the market.
Yeah, no, that's awesome. Yeah,
And on that front, we actually have a tool. It's just a spreadsheet with a couple fields that you fill in that we'll share with you and your community, where you can just put in purchase price, the leverage you're looking for, you know, the rate, you know, you can type in the rate and then it calculates, you know, and you put rental income, tax, insurance, and it calculates your cash flow and your DSCR. And I guess one other thing to mention, it's kind of interesting, is that right now I guess having people understand an amortizing loan versus an interest only loan. Exactly. So we're doing a lot of loans right now where it's a 30-year loan with a 10-year interest only period up front. So you're not paying down the principal of the loan, but what you are doing for yourself is decreasing your monthly payment, thus increasing your cash flow. So that's an interesting concept for, you know, both a less experienced and very experienced investor, you know, to know that.
How's the debt service coverage ratio calculated on something like that? That was something that we had talked about a while back. Was one of those loans was 10-year interest only with on a 30-year AM. Is the debt service coverage ratio change once that flips over? If you even take that, even if you take it to the full 10-year mark,
it used the DSCR qualification for closing the loan and funding the loan on our side is based on the interest only payment.
Interesting.
I would just say my guess is we're highly likely seeing any loan that we've done in the last 12 months at rates in the, you know, 5, 6, 7, 8% range, you know, that you are refinancing those to lower rates as rates slowly drop over the coming.
So, and what I've said this on Bigger Pockets, I've said it in this community too, is like, do not discount short-term rental, any type of investing, long-term, short-term, rehab. Do not discount any type of real estate investing right now, even when interest rates were going up almost every single month. Underwrite the deal, put it through an Excel document, put it through your processes, and see what the cash flow is going to be. Because for you to say, okay, like we were looking at an interest rate that was an SBA loan close to 9.5%. And on paper, that looks absolutely terrible, especially on a $2.5 million loan. But it's still cash flowed. It's still the debt service coverage ratio still worked and everything. So we ended up still going through with that property, even though it sort of hurt because I mean the payment was probably an extra $8,000 extra a month, but the numbers still checked out. So that's what I've been telling everyone is just because everything that's happening in the markets right now, that doesn't mean you should just be discounting real estate investing completely. There was one thing that you had mentioned that I've never taught to this community before, and it was the BURR strategy for short-term rentals and just the BURR strategy in general. So that's mainly what I want to talk about for the next say like 5 minutes or so, and just wrapping up this podcast episode is that is such a powerful strategy that I mean there have been books and entire courses and entire masterminds created around just the BURR strategy alone. So would you guys mind just diving deep into what exactly that strategy is and how to apply it to different types of real estate assets?
Sure. Yeah, so BURR strategy: buy, renovate, rent, refinance, repeat. So you're really fixing and renting a property, simpler terms. So that strategy has been around for a while. You're building equity in the property by creating value but through renovation. And so really there's not, it's not rocket science to just at the last part of it, instead of getting a long-term 12-month lease, to throw in someone, medium-term lease or short-term rental that property. What it does is you got to go backwards to what market are you looking at doing this in, and does it support the medium-term lease or rental income. So I did this myself. I'm in Colorado. I love to ski. I bought the ugliest Vail condo I could find in 2020, right after, middle of 2020. So I have all this fear. I bought a
Perfect time.
property,
Yeah.
renovate it. So basically, you can go to a lender like us, a hard money lender, or you could try to get conventional financing. I'll talk about the pros and cons, but so you buy a property, let's just make the easy numbers, $100,000 property. You go get a conventional loan, you might be able to get 80% financing on that 100,000 purchase. So you're 20 grand into that. They're unlikely, unless you want to try to go through one of those crazy home style loans. You're gonna be paying for the renovation out of pocket, right? So what we do as a lender, depending on your experience as a real estate investor, we would provide 80 to 90% of the purchase price and 100% of the rehab. You add those two parts up. If that loan is under 75% of the as completed value, after repair value, we give you that loan, right? So it's a short-term bridge loan. It's at higher rates than that conventional loan, but we just gave you 85, let's say 85K of the 100K, plus your 50K rehab budget, because the appraisal says it's going to be worth 250 at that. All right, so you just got more money from your lender, less money out of your pocket. It costs you a little financing cost, but you could do 2 or 3 of these projects at once with the same amount of your personal money than doing one with the bank. So that's the first part of it. And then, for it to work as a BURR to short-term rental, you have to be buying in a zone, in a submarket that supports that. So then you can basically, you're done with the renovation. You can call up Caitlin and say, hey, here's my report. Can your team pull your AirDNA report? Show me the income. All right, looks like I qualify for rate term refinance, because your loan is at 75% of that exit value. That's how we set up the loan up front. And so now you can do rate term refinance instead of cash out. So the difference to a lender is we can provide higher leverage on rate term where you're not getting significant cash out. And there's a rate adjustment for almost every lender, bank, private lender, hard money lender. It's a cash out, they're going to increase the rate. So by doing that first loan, you use less of your money. You can now do a rate term refinance at a lower rate and get that property into long-term financing using estimated short-term rental income on the property. So it's exactly what I did on my Vail condo. I would say I treat it as a short-term rental, but I also use it a lot, so I'm not
Yeah.
maximizing income. But you know, you can also be looking at that market, a vacation rental market, depending on what type of vacation area it is probably going to appreciate over a 5 to 10 year look back. So
You can't
now
take the landscape away, is what I say. No matter what happens in the market, for if you're in a scenic area, you can't take the landscape away. Yeah.
So yeah, that's the summary.
Do you guys lend on, say, like duplexes or triplexes, same strategy? Or
Yes.
does it have to be single family? Yeah. Or I mean, you said condo, but like, will you guys rent on duplexes, triplexes, and whatnot?
Yeah, so in our world, single family is 1 to 4 units.
Yep.
And then 5+ is going to be considered, multifamily. But yeah, condos, townhouses, and 1 to 4 units is all in the same bracket of leverage, pricing, guidelines, everything for us.
Do you guys lend on new development, like new construction? Or oh, okay. What
We
do those
do.
terms look like in terms of just, I guess, just normal bank terms?
Yeah, so we're tying up the lot as well. So typically we'll either go in and do a purchase, or sometimes if the borrower already owns the land, we can do a refinance of the lot that they own. So we're going to give anywhere from 60 to 75% of the value of that lot, again, either purchase or refinance. And then we're going to fund all of the vertical. So hard costs, soft costs, up to a maximum loan of typically around 75% of your completed value, similar to a flip. But the overarching margin we're looking at is the total cost of the project. So the lot value purchase plus the vertical. So depending on if it's single or multifamily, we're anywhere from 75 to 85% loan to total cost a project. And we're
It's not
actually
bad.
doing,
Yeah, that's really
yeah,
good.
it's high leverage, and I don't think a lot of people know that exists. You can do these kind of loans
Yeah.
with banks, but they're going to
75
be,
to 80 of loan to cost is crazy, because
yeah.
will you guys also handle the refinance out of the construction loan as well? Yeah.
Correct. Yeah. And that was just going to say that. So we're doing a handful of these projects where it's the build to rent model, or, kind of sort of BURR scenario, where we're taking it all the way through to then refinancing into a perm loan. And they're operating these as either long or short term rentals. So the nice thing is, because we have this full suite of products, a lot of our clients can stay with us through the entire process.
Yeah, which is ideal. Yeah. Switching banks and whatnot.
We make it
Yeah, so
easy and fun all the way through.
Yeah,
the
yeah, yeah.
goal of our business was,
That's
right,
the goal.
we're real estate investors as well. So we created a lending business. You know, it started out small, just fix and flips, but fix and flip people want to then go buy apartment complex, and some of them
Yeah,
keep the
so
property.
you can scale with your clients. Yeah.
Mhm.
And then we expanded from 5 states to 43. So pretty much whatever you're doing in residential real estate investing, we're trying to provide access to capital.
Yeah, that's incredible. So yeah, that's essentially the episode. Is just I love that you guys touched on the BURR and the construction, because that was the BURR thing when Kevin and Caitlin had mentioned it. I was like, I wanted to teach on that eventually. I didn't have too much experience in that realm. I'm a new construction guy, so I can speak on that forever. But in terms of the BURR strategy, I mean, it's a really powerful strategy. If you got, like, I know in the mid here where I live in Asheville, North Carolina, there aren't really too many duplexes, triplexes, and whatnot. But in the Midwest where I grew up, I mean, they're everywhere. And it's like, if you just took one of those and you turned it, I wouldn't necessarily say short term, but say even a midterm strategy close to a hospital. I mean, that's key. That's very powerful. And then if you did a new development strategy on top of that, say close to a hospital for an MTR strategy, that's very powerful as well. So I mean, those were just some of the things that were going off as you guys were saying that. So
Yeah, it's a
where can
great way to
yeah, sorry,
scale
Caitlin.
quickly.
Yeah,
I was
very
gonna say
quickly.
yeah.
Instead of trying to look for 4 different units scattered, or building 4 different units, you just build them all. Because for traveling nurses or whatever the clientele is, I mean, they're not as picky as, say, like a short-term rental guest where they're coming in for vacation and whatnot. A lot of times just like where they're sleeping and just entertaining themselves in between work and whatnot.
Mhm.
Yeah. So where can people find you guys in terms of Aloha Capital, what you guys are working on, and then if you guys want to talk about some of the things that are available to the B&B formula students as well, and then we'll go ahead and wrap it up.
Go ahead,
Yeah.
Kevin.
All right. website's alohaprivatelending.com. So there you'll find information about all of our loan programs. One thing we didn't touch on is we provide passive investment opportunities. We talked about that on a different episode. So we have a fund vehicle that you can invest in passively that basically owns a portfolio of the loans, the notes that we create. And we just started beginning of this year selling individual notes to investors. So you can actually buy a note or a fraction of a note from us. And the interest received on those as investors between 9 and 12%.
It's like you're investing in real estate without investing in real estate. Yeah, that's powerful.
Super passive. We just drop money in your bank account. So yeah, alohaprivatelending.com. You can find information on our loans and our passive investments. And then we are going to provide Alex with a little cheat sheet spreadsheet for calculating DSCR. We have an online loan app that's going to be specific for this community. So we'll know it's from this community, and then anyone that we get a loan app from and we do loan to this community, we're going to do $500 off those loans. So
yeah, and all those links will be below, guys, on this episode somewhere, if you guys are looking for those. Okay. Awesome. Appreciate you guys.
Thank you, Alex.
Thanks so much, Alex.
Thanks, Caitlin.